In this video, I am going to go over how lenders calculate your mortgage interest rate and how you can influence that rate to be lower when you apply for a mortgage. So mortgage companies calculate your interest rate based off the risk of the borrower that you are and of course the financial climate and what interest rates are at on the 10-year bond. Don't worry about that. There's nothing you can do about what interest rates are at, but you can dictate what your risk is to the bank. So what that means is you want a high credit score, you want a low debt to income ratio, you want high income, and you don't want any derogatory things on your public records or credit. You don't want any foreclosures. So I'm going to talk about how you can influence some of these categories to make sure that you look like the lowest risk borrower possible, which will get you the best interest rate possible. Let's get right into it and talk about credit. Now, obviously, a higher credit score is better than a lower credit score, and generally, if you have a higher credit score, you're going to get a lower interest rate, and if you have a worse credit score, you're going to get a higher interest rate. One of the highest weighted scoring factors is something called credit utilization, which is basically the room you have on your available credit. So if I have a credit card with a zero balance and it has a max of $500, that gives me $500 of credit utilization that I could use. You get more points for that amount. So if it was a $1,000 credit limit and it's zero balance, I would get even more points. So if I max out all my credit cards, that's really bad and that will hurt my score because of credit utilization. So in a practical sense, if you're thinking about buying a home in the future and you have high credit card debt and you want to maximize that interest rate, then try to pay that stuff off. But keep in mind, sometimes it's more important to have the cash for your down payment or furniture or things that you need to buy. So again, this is very specific to each person and your goals. But generally, if you want to increase your credit score, if you pay down your debt so that you have better credit utilization, you'll get a better score and you should get a better interest rate. All right, so this one's a bit confusing about credit, but the age of your credit matters. So if you had a credit card for 12 years, it gives you more points than if you just open a new one. And so actually opening new credit is a negative. So if you're thinking about buying a house, you might not want to apply for more credit cards and things like that. If you're buying a house immediately, because what I'm about to say is kind of opposite of that. Now, if you don't have a lot of credit, and say you want to buy a house a year or 2 years from now, you probably want to add some credit cards or some things where you can expand your credit utilization. In the short term, your credit might get damaged a little bit by opening up these new debt accounts. But over time, you will increase your score by having more credit utilization. So that's why it's important to know what you want to do and strategize, right? Because if you're thinking about buying a home, in the short term, you should not open any new credit. But if you don't have a lot of credit already and you want to build that credit up and you're going to buy a house maybe a year from now or 2 years from now and you're just planning for long term, then definitely open up some credit and try to max out not your balance, max out the maxes on your credit cards, etc., so that you have more runway there or credit utilization score. If you have open collections, you got to get them things closed if you want to increase your score. So work out a deal with the collections people, pay it off, whatever you got to do, but get those things closed. That will get your score up. And then lastly about credit, make sure you make all your payments on time. If you don't, there's not a lot you can do about it because those late payments just have to fall off. Keep in mind that if you're getting an FHA loan, that it's much less credit sensitive. So if you have a poor interest rate on FHA, it will hurt you less than if you go conventional. If you're getting a conventional loan and you have bad credit, that rate is going to be really high. It could be a couple points higher. On FHA, it might only be a quarter point or a half a point higher than if you had perfect credit. So when you're making a decision on what mortgage to get and you don't have the best credit, even though FHA loans cost more normally, it might be better to go that way depending on the rest of your situation. And that's why it's really important to talk to a professional before you make any decisions about this, because everything matters on your specific situation. This video is just general information that you can use to make mindful decisions about your finances and how you can put yourself in a better position. But when it comes down to applying for the mortgage or strategizing with a loan officer, you're going to want to talk to them in detail about your specific situation, because something that normally is something that you should do could not be something that you should do depending on what your situation is. So keep that in mind. All right, the next category is called DTI, or debt to income ratio. I have a video that elaborates much more about what it is and how you calculate it. I'll link it. I never know what direction is. It's like reversed. In the most simplest way to explain debt to income ratio, it's basically a percentage of your income that's paid to your debts. So if I make $1,000 a month and I have credit card payments and mortgage and whatever other debt payments are $500, that means 50% of my income goes to paying debt. So my DTI ratio is 50%. Now in this case, the lower the percentage, the better it is for you and the better interest rate that you would get. So with this ratio, you have income and you have debt. So to improve it, you can increase your income. That's kind of hard if you're working a regular job, but I have some tips on that. But let's first talk about your debts. One of the easiest ways to increase this ratio is to eliminate some debts. So if you have a credit card, if you pay off that credit card, whatever the monthly amount that you had to pay on it goes away, and then your DTI will do a lot better, which the percentage will come down, which is good. Now again, I know I keep saying this, but you want to balance this with the cash that you need on hand to buy a house. So if you don't have a lot of cash and you could still qualify with a higher DTI, then you might want to do that. Don't spend all your cash paying all your debts and then you can't buy the house that you wanted. So again, check with your loan officer and strategize before you make these type of decisions. The whole purpose of this video is so that you know what's happening. So if a loan officer tells you, hey, pay off this credit card, you'll understand why he's telling you to do that, and you can have an intelligent conversation about it. All right, so going back to income, which it's like, how am I just gonna make more money magically? You can't. But if you work a W-2 job, if you get a regular paycheck and you have things like commissions or overtime, you want to make sure that you're maximizing your overtime and maximizing your commissions, because the lender is going to look at that information a lot differently. Now, if you are self-employed or you're an independent contractor, this is where income really matters. And I think a lot of people make this mistake, right? So if I'm self-employed and I'm thinking about buying a house, I need to be really conscious of what I do with my taxes, because lenders use 2 years of your tax returns averaged together. For you guys that are expensing everything and showing no income and basically paying no taxes, that's cool. But when you go to buy a house, it's going to be a lot more difficult, or impossible actually, because you're showing no income. So if you're ramping up to buy a home and you're self-employed, you might want to not expense everything the way that you have been doing so that you can qualify. Now there's other loan programs and things that you might be able to take advantage of, but if you're going into the conventional mortgage system, it's going to be very difficult when you're self-employed and you write everything off. So keep that in mind. This is a really, really important thing to know if you are self-employed. You need to know this information so you can make an educated decision about your financial future. That's all I got for you guys. Hopefully this information is helpful. Hopefully it gave you some things to think about when you're talking to your loan officer, because I can't stress enough that you want to strategize with a professional so they can give you all the guidelines and you can explain your situation to them so they can tell you what you should be doing. I'm curious what your biggest issues are or your biggest questions. Put those in the comments. If you need help directly, feel free to call, text, or email me. I pride myself in my accessibility. I will get back to you as soon as possible, normally within 24 hours. And you could be anywhere in the country. I'll do my best to help you out. Thanks, guys. Bye-bye.